So one minute the Indian market is hitting all-time highs, and the next, it's an absolute freefall. What on earth just happened? Well, that's what we're here to figure out. Let's break down the perfect storm that sent everything tumbling. I mean, this thing happened fast. It was a sudden, stomach-dropping plunge that just caught so many people off guard. We're talking about portfolios and market sentiment getting turned completely upside down in just a matter of hours. And here's the big, scary number that everyone's talking about, the Sensex, down over 500 points. Now, that's not just a small dip, that's a huge drop that signals some serious trouble and tells you a ton of people were selling, and selling fast. Okay, so that brings us to the billion-dollar question, right? Why? Was this just a freak accident, a random bad day on the markets? Or was there something more going on? A perfect storm of different things all hitting at the exact same time? Well, let's follow the clues. All right, first stop on our investigation, we have to look outside of India's borders. You know, in today's world, no market is really an island anymore. What happens thousands of miles away can create some pretty massive waves right back at home. And it really started with this really potent mix of bad vibes coming from the world's two biggest economies. Okay, so on one side, you've got the US, where investors were just holding their breath, waiting for key jobs data and for the Federal Reserve to say what it's going to do with interest rates. Then, at the same time, over in China, there were these huge fears about a massive property developer going bust, which sent a shiver down the spine of the entire Asian market. Put those two together, you've got a global wave of anxiety. And this wasn't just a hunch or a feeling, you know? There were cold, hard numbers backing up all this nervousness. The US Treasury yield, which is basically a big flashing sign for investor caution, was ticking up. Major tech stocks all across Asia were just bleeding value. All of this created what traders call a risk-off mood. And that's a really simple idea. It's when the big money gets scared, so they sell anything that looks risky, like stocks, and they run for safety. So you can see the global stage was perfectly set for a sell-off. But what took that general worldwide anxiety and turned it into a full-blown crash in India? Well, that's when we have to look at the pressure points that were already building up right at home. Okay, to really get what happened next, you have to know about a group called the FIIs. The easiest way to think of them is as the whales of the market. These are huge overseas investment funds. We're talking billions of dollars. And when one of these whales decides to make a move, especially a big sell, they can create waves that move the entire market all by themselves. And that is exactly what happened. The FIIs started selling, just dumping stocks left and right, partly for some year-end tax reasons. And when they start selling off the giants, you know, the HDFC banks and the Reliances of the world, it's like pushing over the first domino. The whole index just gets dragged down with them. Then you pile on a weakening rupee and serious pain in big sectors like autos and metals, and boom, you've got the recipe for a massive sell-off. But there was one final crucial ingredient: the timing. See, all of this went down during a holiday period when a lot of traders are just not at their desks. This creates something called holiday thinning, or low liquidity. Think about it like this. If you throw a rock into a deep ocean, it doesn't do much. But if you throw that same rock into a shallow puddle, it makes a huge splash. It's the same idea here. With fewer buyers around, every big sell order made a much bigger, more negative splash on prices. So, okay, we've covered what happened, but how do you actually measure the feeling in the market? Like, how can you put a number on fear? Well, believe it or not, there's actually a tool for that. Think of it as the market's official anxiety meter. It's called the VIX, or the Volatility Index, and the concept is super simple. When the VIX is low, everyone's pretty calm, but when the VIX is high, it means investors are getting really anxious, and they're expecting some big, wild swings in the market. It really is the official fear gauge. Right, and on the day of this crash, the VIX didn't just creep up, it jumped. I mean, it spiked all the way to 16.50. That was the flashing red light, the undeniable signal that pure fear was starting to take control of the market. So what does a number like 16.50 even mean? Well, to put it in perspective, for people who do this for a living, a VIX in the mid-teens basically screams caution. It's a clear warning shot that says, hey, things are getting choppy and the market is entering a bit of a danger zone. Okay, so after a day that shakes everyone up like this, the big question on everyone's mind is, what happens now? Where do we go from here? Let's put all the pieces together and see what the experts are keeping a close eye on. So let's just do a quick recap of the recipe for this crash, right? Step 1, you had those global headwinds from the US and China that put everyone in a risk-off mood. Step 2, that mood pushed the big foreign investors, the FIIs, to start selling. Step 3, that selling got way worse because of the low holiday volume. And finally, step 4, the massive spike in the VIX, the fear gauge, just confirmed that anxiety was running rampant. You see how each step just fed right into the next one? All right, so looking ahead, traders have their eyes glued to a few key signals. For the Nifty index, they're watching specific price levels. There's a support level at 25,800. Think of that as a floor they really hope the market doesn't break through. And then there's a resistance level at 26,200, which is like a ceiling that's going to be tough to punch through. But honestly, nobody thinks real confidence is coming back until that VIX fear gauge starts to cool down. And until that happens, you're seeing exactly what you'd expect. Investors are running to safer assets like gold and silver. So when you take a step back and look at the whole picture, the biggest takeaway is this. This wasn't just an India story. It was a global story through and through. And it really leaves you with a huge question for the world we live in today, doesn't it? When everything and everyone is this connected, can any single country's economy ever truly stand on its own?